macro currency signals.
What I'm about to lay out for you is not hype, it's not fantasy, and it's not built on wishful thinking. It's built on patterns, pressure, and math. If you own silver, or if you're even considering it, you need to listen carefully because the world is shifting beneath your feet. Most people sense that something is wrong with the financial system, but they cannot articulate it. They feel the pressure at the grocery store. They feel it when they pay rent, when they fill their gas tank, when they look at their savings and realize it doesn't stretch the way it used to. But they don't connect the dots. They don't see the mechanism quietly draining their purchasing power every single day. We are living inside the largest monetary experiment in human history. Never before have so many currencies been untethered from tangible backing at the same time. Never before have governments expanded balance sheets so aggressively, so casually, and with so little restraint. The idea that money can be created without consequence has become normalized. Crisis appears and liquidity floods the system. Markets wobble and new programs are introduced. Debt climbs and the solution is more debt. The cycle repeats until the cycle itself becomes the problem. Before we go any further, if this breakdown is resonating the way it should, make sure you're subscribed and that notifications are turned on. In environments like this, timing matters. Being early isn't a luxury, it's the edge. Drop a comment below and tell me where you're watching from and what time it is on your side of the world. This conversation isn't confined to one country or one market. It's global, and seeing how far this reaches says more than any headline ever will. Now understand what just happened. Here's the fundamental truth. Currency is a claim on real goods and services. It represents stored labor, stored energy, stored productivity. But when currency can be created in unlimited quantities, those claims multiply faster than the goods themselves. And when claims multiply without a corresponding increase in real output, each individual claim becomes weaker. That weakness is what you experience as inflation. It is not accidental, it is structural, it is baked into a system that relies on expansion to survive. You may be told that inflation is temporary, you may be told it is under control, but control requires discipline, and discipline requires restraint. Restraint is politically unpopular. It is easier to create new money than to make hard decisions. It is easier to stimulate than to cut. It is easier to promise than to reform. So the expansion continues. And with each expansion, the underlying currency erodes further. Now consider the scale of global debt. Sovereign debt, corporate debt, consumer debt, derivative exposure layered on top of all of it. These obligations are denominated in currency units that are steadily losing purchasing power. The only way such a structure can remain standing is through constant liquidity injection. Remove the liquidity and the structure shakes. Increase rates too aggressively and cracks appear. Allow markets to correct naturally and leverage implodes. So, intervention becomes permanent. This is where the illusion of stability enters the picture. Markets rise, asset prices inflate, retirement accounts show gains. Headlines speak of resilience. But look beneath the surface. Ask what is driving those gains. Ask whether productivity is rising proportionally, whether real wages are keeping pace, whether debt burdens are shrinking. The answer is uncomfortable. Much of the perceived stability is built on artificially low rates, continuous intervention, and expanding credit. History does not forgive monetary excess. It documents it. It records what happens when paper promises outpace physical reality. Fiat systems do not collapse in a straight line. They erode gradually, then suddenly. Confidence fades slowly, then disappears quickly. And when confidence in currency declines, capital seeks refuge in tangible assets. This is where silver enters the conversation. Silver is not just another commodity sitting in a warehouse. It is a monetary metal with thousands of years of history. It has been used as coinage, as a store of value, as a medium of exchange across civilizations. But unlike purely monetary metals, silver also has a powerful industrial role. It is essential in electronics, energy infrastructure, medical applications, advanced manufacturing. That dual identity is critical. When economies expand technologically, industrial demand for silver rises. When currencies weaken and inflation accelerates, monetary demand for silver rises. In other words, silver is pulled from two directions at once. It serves growth and it serves protection. Few assets occupy both roles simultaneously. Now let's talk about supply. Silver does not appear because policymakers desire it. It must be mined, processed, refined. New discoveries are rare. Bringing a new mine online requires years of exploration, permitting, financing, construction, environmental regulations, geopolitical instability, Energy costs, labor shortages all constrain output. Existing mines face declining ore grades, meaning more earth must be moved to extract the same quantity of metal. That raises costs and slows production. At the same time, industrial consumption continues to increase. As energy systems evolve, as electronics become more embedded in daily life, as technological complexity grows, silver's role expands. Unlike gold, much of the silver used industrially is not economically recoverable. It is dispersed in tiny quantities across millions of devices. It is consumed. Now, layer investment demand on top of that. In periods of monetary stress, investors look for assets that cannot be printed. They look for tangible stores of value. Silver, historically more accessible than other precious metals, becomes attractive to a broad range of participants. Small investors, large funds, institutions seeking diversification. When that wave of demand intersects with constrained supply, pressure builds. There is another layer to understand: the paper market. A significant portion of silver trading occurs through futures contracts and other financial instruments. These contracts represent claims on silver, but not every claim corresponds to a specific bar sitting in a vault allocated to a specific owner. The ratio of paper claims to physical metal can be substantial. As long as most participants are content to settle in cash or roll contracts forward, the system functions. But if confidence wavers and a meaningful percentage demands physical delivery, strain emerges quickly. Markets built on leverage are stable until they are not. When physical demand exceeds available supply, price must adjust. And in thin markets, adjustments are rarely gentle. Historical precedent reinforces this dynamic. Periods of monetary instability have consistently coincided with dramatic revaluations in silver. It does not drift upward politely. It reprices violently. It compresses years of underperformance into months of explosive movement. Those moves are not random. They reflect the release of pressure built over time. Think about the psychology. For years, silver may appear dormant. It may lag other assets. It may test the patience of holders. Meanwhile, debt expands, currency supply increases, structural imbalances deepen. Then a catalyst appears, a crisis, a loss of confidence, a shift in policy that signals desperation. Suddenly, attention turns. Demand surges, supply tightens, price accelerates, the narrative changes overnight. And this is where the concept of revaluation becomes critical. A 3,000% move sounds extreme until you contextualize it against decades of currency expansion, debt accumulation, and suppressed pricing. If a currency loses the majority of its purchasing power relative to tangible assets, the asset has not become expensive. The currency has become weak. Measure silver not just in nominal terms, but against monetary aggregates, against debt growth, against industrial demand expansion. The gap becomes evident. The disconnect between physical scarcity and financial pricing becomes harder to ignore. The system you rely on is dependent on confidence. Banks rely on deposits, governments rely on bond buyers, markets rely on liquidity. When confidence is strong, paper assets are preferred for convenience and yield. When confidence falters, tangibility becomes paramount. Silver offers tangibility. It does not rely on counterparty performance. It does not depend on a promise to pay. It does not require the stability of a digital ledger maintained by a leveraged institution. It simply exists. That simplicity is powerful in an era of complexity. But understanding this intellectually is not enough. Timing matters. Positioning matters. Waiting for headlines often means paying a premium. Markets anticipate before they confirm. By the time scarcity is obvious to everyone, availability may already be constrained. Consider the velocity of modern information. News spreads instantly. Social media amplifies narratives. A shortage in one region can become a global story within hours. If a surge in physical demand begins, it will not unfold quietly over years. It could accelerate within weeks. Premiums can expand. Inventories can drain. Access can become limited. The opportunity window often closes faster than expected. This is not about panic. It is about preparation. It is about recognizing structural fragility and acting before fragility becomes failure. It is about diversifying out of pure paper exposure into assets with intrinsic value. It is about understanding that monetary systems built on perpetual expansion eventually confront limits. Silver sits at the intersection of monetary history and modern industry. It is finite. It is essential. It is undervalued relative to the scale of global imbalances. And when repricing occurs, it may not be incremental. The question is not whether volatility will return to financial markets. Volatility is a certainty. The question is how assets will behave when trust in currency weakens further. If the response to every slowdown continues to be expansion, if debt continues to outpace productivity, if structural deficits remain unresolved, pressure accumulates. Revaluation is simply the market's mechanism for reconciling that pressure. You must decide whether you want to react to that reconciliation or anticipate it, because when the shift begins in earnest, hesitation can be costly. Assets that were available at one price may not be available at the next, and paper claims may not provide the protection many assume. The fragility of the current system is not abstract. It is measurable in debt ratios, in monetary aggregates, in declining purchasing power. The insurance that silver represents is not theoretical. It is grounded in centuries of monetary history and in present-day industrial necessity. If a currency unit buys less each year, and if tangible assets become harder to extract and more demanded, then over time the exchange ratio must adjust. That adjustment can be slow, or it can be explosive. The stage is set for imbalance. Constrained supply, expanding demand, leveraged financial structures, persistent monetary dilution. These forces do not cancel each other out. They converge. And when they converge fully, price becomes the release valve. So as you think about the future, do not anchor to current nominal prices as if they are fixed reference points. They are snapshots within a moving system. Ask instead what happens if currency supply doubles again. Ask what happens if confidence in sovereign debt weakens. Ask what happens if industrial demand outpaces mine supply more aggressively. Ask what happens if even a fraction of paper holders seek physical metal simultaneously. In each scenario, the conclusion is similar: repricing. This is not about predicting a specific date. It is about understanding direction and probability. Systems built on expansion face consequences. Assets with scarcity and utility benefit from those consequences. Part 1 is about awareness, about recognizing the trap of complacency, about understanding the mechanics of monetary dilution and supply constraints, about seeing silver not as a speculative trade, but as strategic positioning in an era of systemic risk. The revaluation narrative is not fantasy. It is a projection of current trajectories extended forward. And trajectories matter. If you own silver, you are not holding a relic. You are holding optionality in a world where optionality may become scarce. You are holding an asset that bridges past monetary systems and future technological infrastructure. You are holding something finite in an age of infinite currency creation. The next phase of the global financial story has not fully unfolded yet, but the foundations are visible. Debt saturation, policy dependency, currency dilution, industrial transformation. These are not temporary phenomena. They are structural. When structure shifts, prices follow. And when prices follow, they rarely move politely. This is the awareness you need before the crowd recognizes it. Now let's go deeper, because understanding the structure is only half the equation. The second half is scale. Most people dramatically underestimate scale. They look at today's silver price and imagine future moves in small percentages, 10%, 20%, maybe even 50%. But they fail to zoom out and ask a far more important question. What happens when a monetary reset collides with a physical shortage in a world drowning in leverage? A 3,000% revaluation does not occur because of excitement. It occurs because of imbalance. It occurs when the unit used to measure value is destabilized, while the asset being measured remains scarce and essential. If currency supply expands aggressively over years, and if debt obligations require even more expansion to remain serviceable, then eventually the measuring stick itself shrinks. When that happens, assets do not become expensive. They are repriced against a weaker denominator. Think about the size of global financial assets. Trillions upon trillions sit in bonds, equities, pension funds, derivatives, cash equivalents. Now compare that to the size of the physical silver market. It is tiny by comparison. The amount of investable above-ground silver available at any given moment is a fraction of global capital pools. It would not take a massive reallocation to overwhelm supply. Even a small percentage shift from paper assets into physical metal would strain inventories rapidly. This is the asymmetry most overlook. Silver does not need everyone. It only needs enough capital to tip the scale. When markets are calm, most capital remains in yield-generating instruments. But when confidence cracks, behavior changes quickly. Investors do not wait for official confirmation that risk is rising. They front-run it, they hedge, they diversify into tangibles, and when they do, they move fast. Now layer in another reality. Industrial users cannot simply stop buying silver when prices rise. Manufacturers of electronics, energy components, medical devices, advanced systems rely on it. It is not decorative, it is functional. When price increases begin, industrial buyers often accelerate purchases to secure supply, fearing further increases. That behavior compounds investment demand. It tightens availability further. This is how vertical moves are born. The feedback loop becomes self-reinforcing. Rising prices signal scarcity. Scarcity drives urgency. Urgency drives more buying. More buying reduces supply. Reduced supply drives higher prices. In a leveraged paper market, short positions can be forced to cover into rising prices, adding fuel to the move. What begins as a steady climb can turn into a spike. Now consider the broader macro environment. Governments facing high debt burdens cannot tolerate prolonged high interest rates without severe fiscal strain. Raising rates increases debt servicing costs. Lowering rates weakens currency and fuels asset inflation. Policymakers are trapped between inflation control and financial stability. When forced to choose, stability often wins. Liquidity returns. Balance sheets expand. Currency units multiply. Each cycle of expansion erodes purchasing power further. If you extend that pattern forward several years, what do you see? More currency chasing limited tangible assets. More claims on the same pool of goods. More fragility hidden beneath surface calm. The revaluation of silver is not just about supply and demand within its own market. It is about the collision between global liquidity and finite resources. Now let's talk about ratios. Historically, silver has maintained a long-term relationship with other monetary benchmarks. When that relationship becomes stretched to extremes, it tends to mean revert, often violently. Periods where silver is deeply undervalued relative to broader monetary aggregates do not persist indefinitely. They resolve through repricing, and the resolution phase is rarely subtle. A 3,000% move sounds dramatic until you examine how compressed silver has been relative to currency growth over decades. If monetary supply has expanded several-fold, while silver production has remained constrained, then the gap between paper representation and physical reality widens. That gap is tension. Tension eventually snaps. Another dimension is accessibility. Silver is within reach of ordinary individuals in a way many other assets are not. During times of monetary stress, this accessibility matters. Broad participation can amplify moves. When millions of smaller participants decide simultaneously that holding physical metal is prudent, supply chains feel it, dealers feel it, refiners feel it, premiums expand, inventories shrink. The headline price becomes almost secondary to availability, and availability is everything in a crisis. There is also the geopolitical layer. Global trade tensions, resource nationalism, supply chain fragmentation, energy instability. Mining operations do not exist in a vacuum. They rely on stable governance, affordable energy, reliable logistics. Disruptions in any of these areas constrain output further. Meanwhile, strategic competition over technological dominance increases demand for silver-intensive industries. The same metal needed for monetary hedging is needed for industrial advancement. Dual pressure. Limited elasticity of supply. Now imagine a scenario where financial markets experience a significant correction. Equity valuations fall sharply. Credit spreads widen. Confidence weakens. Policymakers respond with renewed stimulus. Liquidity floods back in. But this time, inflation expectations are already elevated. Trust in currency management is already fragile. Capital seeks refuge more aggressively than before. In that environment, silver does not need gradual appreciation. It can gap higher. It can reprice in stages that feel disconnected from previous ranges. What once seemed like resistance becomes a memory. Price discovery accelerates because sellers step back. They anticipate higher levels. Buyers compete for limited supply. This is what exponential repricing looks like. Many assume such moves are unsustainable, and in the short term, volatility will indeed be intense. There will be corrections, there will be pullbacks, but the overall trajectory during a structural revaluation phase can be breathtaking. Those anchored psychologically to old price ranges may hesitate. They may sell too early. They may wait for retracements that never fully materialize. Understanding the psychology of parabolic markets is crucial. Fear shifts direction. Instead of fearing loss, participants fear missing out. That shift alone can multiply demand. And because the underlying physical market is small, the impact of that shift is magnified. Now ask yourself, what is the downside risk of holding currency that steadily erodes versus holding a scarce asset during systemic stress? One loses value slowly and predictably. The other may fluctuate but carries upside convexity during crisis. Convexity is powerful. It means potential gains accelerate as conditions worsen. Silver historically exhibits that convexity. Another overlooked factor is trust in institutions. In highly leveraged systems, trust is the glue. Depositors trust banks. Investors trust clearinghouses. Pensioners trust fund managers. If trust is shaken even moderately, diversification accelerates. Physical assets bypass institutional layers. They reduce counterparty exposure. In a world increasingly aware of systemic fragility, that reduction has value. And value, when widely recognized, commands a premium. Let's address the idea of inevitability carefully. Nothing in markets is guaranteed on a specific timeline, but trajectories matter. Structural deficits, expanding money supply, rising industrial dependency on silver, declining ore grades, elevated leverage in paper markets. These are not hypothetical. They are present realities. When multiple structural pressures align in the same direction, probability increases. A 3,000% revaluation is not a daily forecast. It is a cumulative projection of unresolved imbalances. If currencies continue to expand while tangible supply remains constrained, the exchange rate between the two must adjust. It is arithmetic over time. The only variables are speed and volatility. Now consider generational perspective. Monetary systems do not last forever in their original form. They evolve. They reset. They restructure. Those transitions often involve repricing of real assets relative to paper claims. Individuals positioned in tangible assets during such transitions historically preserve purchasing power more effectively than those fully exposed to nominal instruments. Silver, because of its accessibility and dual utility, sits uniquely in that transition zone. This is not about abandoning all other investments. It is about balance. It is about recognizing that the financial system operates on confidence and expansion, while silver operates on scarcity and utility. When expansion meets limits, scarcity shines. If you own silver, you are positioned on the side of tangibility. If you are considering it, the question is timing relative to recognition. Before the crowd, premiums are manageable. After recognition, they may not be. There will be skeptics. There always are. There will be arguments about volatility, about opportunity cost, about historical drawdowns. Those arguments are valid in stable periods. But structural instability changes the calculus. When systemic risk rises, insurance appears expensive until it is needed. After it is needed, it becomes priceless. A revaluation of the magnitude discussed would not feel orderly. It would feel chaotic. Headlines would shift tone rapidly. Analysts would revise projections. Narratives would change from dismissal to justification almost overnight. What seemed extreme would suddenly be explained as logical. That is how paradigm shifts unfold. You must decide whether to interpret current prices as ceilings or as early stages, whether to view silver as an optional trade or as strategic insurance, whether to measure risk solely by short-term volatility or by long-term purchasing power erosion. Because the true risk may not be that silver fluctuates. The true risk may be that currency continues to dilute while tangible scarcity intensifies. In such an environment, the repricing could exceed conservative expectations. And those anchored to incremental thinking may be stunned by exponential reality. Part 2 is about scale, velocity, and psychology. It is about understanding that when financial systems reach inflection points, adjustments are nonlinear. It is about recognizing asymmetry, limited downside relative to systemic currency erosion, substantial upside if imbalances resolve through asset repricing. The groundwork has been laid over years. Expansion upon expansion, debt upon debt. Demand growth layered onto constrained supply. The ingredients are present. The only missing element is the trigger. And triggers, by definition, are unpredictable in timing, but powerful in effect. When it happens, explanations will come later. Charts will be redrawn. Experts will claim it was obvious in hindsight. But positioning must occur before hindsight exists. That is the difference between observing a revaluation and participating in it. So here's the bottom line. The system you've been told is stable is stretched to its limits. Currencies are being diluted in plain sight. Physical silver is finite and increasingly essential. And history makes one thing clear. When monetary pressure meets tangible scarcity, repricing is not gradual. It is explosive. A 3,000% move isn't about hype. It's about math catching up with reality. If you own silver, understand what you hold. If you don't, understand what you're exposed to. Because when the shift comes, it won't wait for permission, it won't pause for hesitation, and it won't reward those who assume tomorrow would look like yesterday.